Today's video is about the Fed pivot and the stock markets. A lot of people are completely misunderstanding how the Fed pivot will affect the stock markets. I'm going to show you what I know. We're going to cover what the Federal Reserve is going to do at their December meeting, what they're going to do with interest rates in 2023, when the Fed pivot will skyrocket the stock markets, and the next winning play in the stock markets. Let me bring you up to speed. This is a graph of the interest rate set by the Federal Reserve. They kept interest rates at 0% until inflation started shooting up. They realized that inflation was not transitory. In March, they started to raise interest rates. They increased it by 0.25%. In May, they raised interest rates by 0.5%. In June, inflation was accelerating. They panicked and they went with a 0.75% increase. July, 0.75% again. September, another 0.75%. At the most recent meeting in November, 0.75% again. This brings us to an interest rate of 3.75%, so it was a very quick ascent from 0%. This explains how we ended up with mortgage interest rates going from 3% at the start of the year to 7% right now. That's how we got thrown into a bear market in the stock market and a crypto winter. That's how the bond market got surging inverted yields. Quantitative tightening has played a factor too, but we're going to get into that later on in the story. Now, the Federal Reserve has already signaled what the game plan is. The plan is to pivot. And the pivot is going to be a three-step sequence. Step one is when they're going to slow down the interest rate increases. So in other words, smaller interest rate increases, so no more 0.75% raises. Step two, that's when they're going to stop raising interest rates and they're going to take a pause. And step three, that's when they're going to start lowering interest rates again. So we're going to go over this three-step sequence in detail and how this is going to impact the stock market because a lot of people are getting this wrong. The Federal Reserve has been raising interest rates by 0.75% 4 times in a row now. And we all know, this is no secret, they can't keep on doing this forever. Sooner or later, they're going to have to slow down. The Federal Reserve wants to get interest rates to approximately 4.5%, and we're at 3.75%. The next 2 meetings are on December 14th and February 1st. It is expected that the Federal Reserve will raise interest rates by 0.5% in December and then 0.25% in February. So that's going to get us to the magic number of 4.5%. According to the CME Group, the probability that the Federal Reserve raises interest rates by 0.5% in December is 85.4%. That is the market's expectation. So is that expectation justified? In my opinion, I believe that that expectation is justified. Back in June, the rate of inflation was 9.1%. In October, inflation fell to 7.7%. So was June peak inflation? Nobody knows for sure. I believe that it was in this economic cycle. Now, here's the thing. When the Federal Reserve raises interest rates, it takes time for that pain to be fully felt by the economy. So basically what I'm saying is there's a lag. So even if we stop raising interest rates right now, the economy would continue to get worse because of the lag. Ultimately, people are no longer flush with cash. They're not spending money like crazy. So I don't see a surge of inflation to take us above June levels, especially with the expectation that the economy will get worse. I understand that energy prices are forecasted to get more expensive, but I don't think it's going to be enough. And trust me, as most of you already know, I stockpiled Exxon when it was $30 a share. So you're preaching to the choir. It's above 112 right now. With that being said, if inflation were accelerating higher, then the Federal Reserve would have to keep on raising interest rates by 0.75%. However, that is not the case. The November inflation report will be released on December 13th. The Federal Reserve finishes up their meeting on December 14th, so the next day. As long as inflation doesn't skyrocket higher in November, I think the Federal Reserve will feel comfortable slowing down the interest rate increase to 0.5%. If that happens, then the Federal Reserve will be initiating phase 1 of the pivot. So the stock market is most likely going to rally higher on December 14th. Most investors will say, well, if everybody is expecting that step one of the pivot on that day, then it's already going to be priced into the stock markets. Kind of, but not really, because the stock market does not like uncertainty. So yes, investors are expecting a 0.5% rate increase, but when it happens, when it actually happens, it will remove the uncertainty, which is a good thing for the stock market. Now let's talk about next year, 2023. So you have to understand this. When step one of the pivot begins, that will not trigger a sustainable stock market rally. The first meeting in 2023 is on February 1st. Whether they raise interest rates by 0.25% or 0%, it's difficult to say. But honestly, 0% or 0.25%, what is the difference? The bigger takeaway is that after the final rate increase, there's going to be a pause. The Fed is going to keep interest rates high for quite some time. And that's the thing, and that's the bigger question. We don't know how long the Federal Reserve is going to keep those high interest rates at those restrictive levels for. The Federal Reserve is not offering clues on this. They're being vague. They're being very vague. They're saying it's going to be for a while. But what does that mean? Does that mean 3 months, 6 months, 9 months? Honestly, I think that they're being vague because I don't think they have any clue either. So they're just saying that they're going to be data dependent, which means that they're going to be reactionary. So we'll see how things develop. Now, let me tell you what the Federal Reserve is expecting to happen. This is their forecast. They're saying that inflation is going to fall to 3% late next year. In 2024, they expect to reach their target goal of 2% inflation. However, getting there is not going to be pretty. Jerome Powell said the path towards a soft landing has narrowed. So he's doubtful of a soft landing. So if it's not going to be a soft landing, then what is it going to be? It's going to be a crash landing. It is expected that the economy will get worse. The Conference Board is predicting a 96% chance of recession. Ned Davis Research is predicting a 98% chance of recession. The Bloomberg model is predicting a 100% chance of recession. Not even 99.9%, they're saying 100%. And 85% of CEOs are expecting a recession. During a recession, you know what's going to happen? Companies on the stock market will be making less money. Corporate profits will fall. And then stocks will need to be repriced lower based on valuations. I told you what you can expect at the December meeting. Now let me tell you what you can expect for next year in 2023. In addition to a recession and falling corporate profits, you can expect more quantitative tightening by the Federal Reserve. This means that they're draining money out of our economic system. They printed too much money and now they're taking it back. The maximum amount that they're going to be taking back is $95 billion a month. So let me show you how they did in September and in October. First week of September, they took back $4.2 billion, so it's a slow start. Second week of September, so that's not good. They printed $5.5 billion, so pretty bad start so far. Third week of September, they took back $16.7 billion, not bad. Fourth week, they removed $18.7 billion. October rolls around and they're off to a strong start. They removed $37.8 billion. Next week, they take a breather, $4 billion removed. Third week of October, ramping up again, $17.3 billion removed. Fourth week of October, $23.3 billion removed. There's a few days spillover into November. We'll cut them some slack here. $33.8 billion removed. Again, the Federal Reserve said that they can tighten by up to $95 billion a month. So September and October, 2 months, that would be a maximum allowable amount of $190 billion. September and October combined total to be just over $150 billion, so not too bad. So the Federal Reserve is getting a little more serious about tightening. It's better than printing trillions of dollars, right? But this is not good for the stock markets. Easy money sends the stock market higher. The stock market loves newly printed money just flooding into stocks. And that is not going to happen in 2023, at least not the first half of 2023. And the reason why I'm showing you the data from September onwards is because September is when they raised the maximum allowable tightening from $47.5 billion a month to $95 billion. So I'm not cherry picking the data. So 2023 is not shaping out to be a good year, at least not for the stock markets. Interest rates will remain elevated, the recession will get worse, rising unemployments, corporate profits will decline, money will not be printed, and the opposite's going to happen. The Fed is going to be taking back that money, quantitative tightening, which means less money to go around. I mean, what else do you want to throw in there for 2023? Rising energy prices, worldwide recession, Europe getting hit hard, Putin, food shortages in the Middle East and parts of Africa. I mean, you tell me, what are the positive catalysts going to be for the stock market in 2023? So listen, if you're looking for a Fed pivot rally, just be careful. Do not get fooled, because there are 3 steps in the Fed pivot. The Fed pivot rally that happens from step 1, when they slow down, that will be a dead cat bounce. It will be unsustainable. Do you know why? For all the reasons that I just mentioned for 2023. Step 2 of the Fed pivot, when they stop raising interest rates altogether, when they take a pause, that will produce an unsustainable rally. We're going to be trading sideways at best. And you may think, okay, step 3 of the Fed pivot is when the stock market is going to skyrocket higher. That's when they start cutting interest rates, and that's when they print money again. So you have to be very careful with this. Be very, very careful. So I'll tell you this, and this is so important, so please pay close attention to what I say. Yes, a sustainable stock market rally will happen after step 3 of the Fed pivot. That will spark the next bull run, but not immediately. It's not like they're going to announce an interest rate cut and then it's going to be immediately off to the races. That is not what history shows. When the Federal Reserve starts cutting interest rates and starts printing money again, quantitative easing, shortly thereafter, the stock market tends to go down for a bit longer. The reason is simple, and it makes perfect sense. Just think about it. The Federal Reserve will only cut interest rates and they'll start printing money again when something breaks, when something goes horribly wrong. So just think of the great financial crisis, think of COVID in 2020. When the Fed goes dovish, it's not an immediate upshot. There's a lag. So something broke, the Fed reacts, but the stock market continues to suffer for a short period of time because ultimately something broke. So whether that be the debt market, the housing market, or the economy. So I'm just telling you to please be careful with your entry points into the stock market. And this should be a good roadmap for you, whether you're a trader or an investor. The optimal time is looking like it's going to be a little bit after phase 3 of the pivot. So you know what I think is going to be the best course of action is when there's blood in the streets and everybody's saying sell, sell, sell. That's when you buy. That's called disaster capitalism. So you know what's going to perform very well? It's going to be commodities. So right now, the US dollar is strong, which is bad for commodities. When the Fed finishes step 3 of their pivot, commodities will go through the roof. Last year in 2021, I told you that oil stocks would be a huge winner this year in 2022. Right now, I'm telling you that when step 3 of the Fed pivot is completed, commodities, especially silver, will skyrocket. So do you know why I'm saying silver in specific? It's because it's going to be the perfect storm. So not only will silver get a boost from quantitative easing and a weakening dollar, but additionally, you need silver in the green revolution. So you need silver in electric vehicles, in solar panels, and smart chips. And all of the easy to mine silver, it's already been depleted. So there's going to be some serious supply and demand imbalances going forward. That's the presentation for today. I hope that's helpful. Please feel free to subscribe. I have a Patreon if you'd like to support our work or if you'd like to join our investing community. I'll leave a link for you down below. Thank you for all the support, and I wish you a very nice day.